Welcome back to the latest edition of the InvestTalk Market Analysis for the week ending October 27th, 2023. Appreciate you all tuning in, liking, and subscribing to this channel, as well as our podcast, InvestTalk. I'm host Justin Klein, and today I'm going to title the video, S&P 500 Support Levels Reached with the Fed Rate Decision on Deck. Kind of a long title, but it pretty much sums up where we're at. Now I'm going to start with the economic data and then pivot over to the charts as usual. Now on Tuesday we had the Richmond Fed Manufacturing Index that did tick down a bit, but still above the zero line. And you can see here is obviously this is the COVID drop, and then this is the period where everyone was consuming physical goods late 2020 into late 2021, and then that rolled over, and you've been in a really a deflationary regime for manufacturing for a good little while. But now we're getting back to growth. So has the inventory correction within the goods space ran its course? I think potentially, and that could be a tailwind, a little bit of tailwind to the overall economy near term if manufacturing kind of gets up off of the mat where it had been really since middle of last year. New single family homes that did tick up again, 759,000, the highest level since February of last year. And it just shows you the new home market is doing just fine. In fact, they're powering along. Now the stock charts aren't keeping up, but you are seeing a good move here in those numbers, and it shows you that the home builders are going to continue to, I think, do fairly well. It's not going to be an '08 crash where they potentially go bankrupt, things like that. They're going to remain in a fairly good position because they can buy down their mortgage rates for their home buyers. They can do things to incentivize people to buy their homes to move product, and it's going to be a bit hit to the margins, but they're coming from high margins anyway, and home prices are high. So, I think that they're going to continue to do well. Durable goods orders, excluding transportation, that was about flat month over month. That was flat month over month, but still growth. So that was a positive. Remember, new orders about what's going to happen going forward, because that kind of fits in with that Richmond Fed survey. Just shows you the manufacturing side of the economy, I think, is doing better. But services side, I think that's where you're going to get some weakness. Real GDP, this is backwards looking. It does bring headlines, 4.9% in the September, in the second quarter, or sorry, third quarter. Let's go Fed Reserve. There we go. That's what I was looking for. So that was 4.9. Let's call it 5%. And the Fed, it's thinking about it. If it wants to, let's see if it wants to show up for me. GDP now. There we go. Here you go. So the fourth quarter that is coming in, they haven't actually made it is over here, 2.2%, 2.2%. It looks like 2.3. There we go, 2.3. So certainly expectation of the market or the economy decelerating into the fourth quarter, and I actually think we'll hit a recession sometime early part of next year, and you're starting to see certain parts of the market or the economy really weaken. Here's the Kansas City Manufacturing Index that was negative for the second month in a row, so a bit different look from the Richmond one. Total vehicle sales that did tick up a bit, 16 million vehicles. That's decent, right? That's not the highs, but it's certainly not the lows either. And obviously you're going through a strike, so there's less supply out there, higher interest rates obviously impacting potential buyers. So this is holding in there, and I think there's just a lot of pent-up demand still in an era just a couple of years ago where there was tight supply. There continues to be tight supply in the car market, but it's been tight supply for a while. So there's still a lot of people pent up. Eventually they have to throw in the towel. I need to buy a car type of thing, and I think you continue to see that. The most important data point, though, in the week was this PCE number, the Fed's preferred gauge of inflation, and that did tick down slightly year over year, 3.44%. And you see this, we're basically going sideways after this big deceleration in rates. We're now plateauing. in the mid threes. And core is also now in the mid threes, 3.68. That did come down from 3.84. So 2 months in a row in the threes. And on that's year over year. If you look on a 6-month basis, we're more like in the high twos. And it's pretty clear inflation is in the ballpark where the Fed wants to be. And consumer sentiment, that decelerate again. Obviously, interest rates going up. That's not good. And ultimately, this all means the Fed is going to pause. 99.9% chance the Fed rate decision next week is going to be a pause. And you're starting to see cuts being priced into the market. There's now a slight chance, 0.1% chance, there will be a rate cut in the December meeting, or at least one of these meetings, this meeting or the next one. Probably not this meeting, potentially next meeting, but probably not either. But you start getting into next year, and once you get to March, you now have a 13% chance of a cut. 13% chance of a cut. Now, it's still higher chance of a rate hike between now and then, but this is creeping up. As you can see, a month ago, this is only at 9%, and now it's at 13%. And then you go to May, right, the third meeting of the month or of the year, and 2 cuts is now at a 5% chance, and 1 cut is at a 32% chance. So you have about a 40% chance that the Fed will cut rates by the third meeting of next year. It's only 5 meetings away. Not that far, right? That's May 1st. So you're talking basically the end of 6 months from now. So you're getting into that territory, and that's what's, I think, giving pause to the dollar, et cetera. So let's dig into the charts and talk about the support, the S&P 500 support levels. And we are now in a stock market correction, officially. Now the question is, will this turn into a bear market? Or will we have a Santa Claus rally? That's the big question. Now, this support level is the 618 from the banking crisis lows, right? 3,800 or so, all the way up to 4,600, and now we're back up down to 41 and change, 41.17 at the close. A little bit of bounce to close the day, closed above that support level. This is also an area of support. You can see this, see over on the right, these blue bars. This is what we call volume at price. And it shows you that typically is support, that is a support level when it gets there. Why? Because a lot of people may have shorted here, right? And they were down because the market went up, and now we're back to those levels, they're break even, right? So when you have a lot of trades at a particular price and you get back to that level, there's a lot of people that are break even. And either people don't want to lose money, or now they're losing money and now they're getting back to even. And that's kind of how this typically works. And so I expect this to be a decent support level, more than decent, a good support level. And we have the Fed meeting on deck next week, the Fed rate decision, and we know they're going to pause, but it's about what they say about future policy. Are they being clear that, hey, we're done, right? They've talked the last couple of weeks about how the long end of the curve rising so dramatically has tightened financial conditions for them. I talked on yesterday's show about financial conditions and the financial conditions index. And a big factor is where the 10-year is, where credit spreads are. And you're starting to see a little bit of stress. Here's the SHYG to the SHY, and this is rolled over. Now, it's not below the banking crisis lows, so I don't think there's a major breakdown here, but clearly yield spreads have widened out. That's what this is telling you. But, the S&P made a new low, equities made a new low over the past couple of days, but this has not. So is this sneaking out or sniffing out that, hey, the Fed is going to admit to a pause? That, hey, yes, there's more work to do, but we need to kind of relax, wait it out, keep rates at these levels for a period of time, and see what the economy does into next year. So I could easily see that being the signal that comes out of the meeting on Wednesday. And the big tell will be where the dollar goes, right? You had a bit of strength in the dollar, and you have this MACD divergence here. I think the dollar is looking to top out. Let's go to a weekly chart. You had this top out in middle of last year on the expectation that the Fed was done hiking. They weren't. You got a resurgence in the dollar, despite the fiscal conditions continuing to deteriorate for the United States and the Treasury. And I think ultimately they need the dollar down in order to finance these deficits. Deficits continue to go up. We have $1 trillion in new issuance at the back half of this year. It's a lot for the market to really handle. Okay, and this will be the ultimate tell. Does the dollar turn? Do credit spreads turn back down? Right. So if we go back to this chart, you would want to see. It's a weekly chart. You would want to see this move back up. And that would be positive for risk assets, positive for equities. If you get this breakdown, you start breaking these not COVID lows, the banking crisis lows, then that would be more of a worry that this pullback in the market, this correction in the market, that's all this is a 10% pullback in the market. 10% pullbacks are very common. We have had 2 now. Actually, no, this was not 4,200 to 48. Yeah, it was close. I think we actually did get to official correction during the banking crisis. This looks bigger, but that's because it started from a higher number. It's a 10% correction. So ultimately, I do think we head higher. And I think we're likely to create a low in the next week or 2. And what's telling me that is the fact that credit spreads didn't break down. Gold is rising. If you're going to have a major deflation, it's really hard to have equities break down without a major deflationary impulse. And gold is going the other way, right? This is sniffing out inflation. This is sniffing out a rate cutting cycle ahead, which would be good for asset prices. Obviously, geopolitics are doing this as well. And I still think gold's over the medium to long term is going to start to outperform the S&P. Look at this. Gold to the S&P. Just absolutely crushing it. Absolute massive reversal in this ratio. Made a higher low, right? This bottomed basically when the S&P peaked. And you're going through this correction in the S&P while gold is remaining steady and now moving higher. Right, let's go to a weekly chart. This is bullish consolidation. In fact, you could argue you actually have a reverse head and shoulders here. Now, it's not triggered yet, but technically this is a reverse head and shoulders on gold. Now let me teach you something. This is how you would calculate the target on this pattern. This is a clear, very valid reverse head and shoulders. So you'd take the bottom of this head, you'd measure to the neckline, let's copy it, let's paste it, and wherever this breaks out, let's say it breaks out here, you'd be going to 2230. I think it's very possible on gold. You have 3 peaks, and usually they get a breakdown or a breakout. 4th time, it's usually breakout, and we're getting close to that. And so that's why I think we are headed for a breakout in gold. Not only this broader pattern, but this big reversal over the past call it month. So huge potential move ahead in precious metals. Move index, this is consolidating to move higher, and that would also, I think, precipitate a Fed pivot to a pause, not an easing, but you start with a pause, and then eventually that gets to signaling rate cuts, which I do think happens next year. Let's look at commodities more broadly, not just gold, but look at this. This is just still in an uptrend. You had oil close out the week strong. XLE pulled back. Chevron had rough earnings. Exxon pulled back. So a lot of the smaller cap names, like if you go to OIH, not nearly as bad of a pullback. This is the oil services, so you don't have those Exxons and Chevrons in that index. Utilities are also gaining a bit of strength. So we'll see what that does, but you're getting that MACD divergence here. And was that the final flush low for this bond proxy, right? So here's IEF. This would be the 10-year Treasury bond price, basically. And this looks like it's wants the bottom. Look at this MACD divergence, right? This is the inverse of this 10-year, also getting that MACD divergence. I think rates are ready to peak. And obviously that would relieve pressure on asset prices, on equity prices. I think we're getting close to that. The other big move or big news this week was growth to value. Now that got a little bit of rebound on Amazon's good earnings, but the breakdown in Meta as well as Google, right, very economically sensitive, right? They're in the ads business, and they both broke down. And so I do think that you get a rally, but I think it's actually going to be a rally if the dollar does roll. That's going to give even more power to the energy sector, the commodity sector, the industrial sector, right? Industrial sector has been pretty weak, and you're testing the low end of this, this support level back from the March lows. So that's getting into a pretty good buy zone as well. So I think that's where you'll get the biggest rally. The KVE also had a nice rally on Thursday. A little bit gave back a little bit on Friday, but still didn't close below the Friday lows. So is that going to sniff out a potential peak in rates? Because that's what's really been weighing on their business. Now, long term, I still think banks are not that great, but near term, they could get a very strong relief rally if you get some level of peak in rates. Real estate sector that also had a lot of volume. Big move on Thursday. Once again, didn't close below it, so that could get a rebound as well. Probably less bullish on that than I would near term than I would be on the banks, but something to take note of. Let's see what else. Let's look at the VIX. The VIX did have a nice spike into the low 20s, but historically this isn't that high. So I would say that's probably the biggest worry here, is that the VIX isn't getting into panic territory. Now, I will say near term, there's a lot of skew to the VIX than there used to be because of what are called zero DT options that kind of depresses vol in the market. And so, this may be the new peak, right, in the low 20s, whereas it used to be in the low 30s, right? It's hard to tell just because of that new entrance to the game, which are those days till expiration options. Let's see what else. I think that's about it. Actually, let's go to NYC. That one also is coming into these support levels from the March lows. So, we'll see in the coming few days, I think, where we get to see support, where support comes in. I think the S&P support levels are here. And that lines up with that Fed meeting. Now, once again, the biggest worry is that the volume on the S&P is not extreme. So we're going to get that panic selling, okay? Now the Qs, see, do we get that on the Qs? Qs is pretty high. You're getting in the 200-day moving average, so that's going to be another support. So there's a lot of support levels that could allow a bounce and into your end. And equities, even though we had this pullback, equities are still positive. And we are, after next week, we're getting into holiday season, right? Santa Claus rally starts to take effect as we get into the back half of November. And so when the market's up and you go into the holiday season, typically you get a low volume float with money flowing into equities, continue to flow into equities. So that's why I'll say I'm actually modestly bullish into year end from here. This is kind of what I was expecting. There's another aspect to charting, which is basically a series of three bottoms, right? One, rally, two, rally, three. And into support. And I think this pattern is pretty consistent with what we should see. And the fact that, we should get some some help from the Fed, who is likely to be a bit more accommodative as we go into 2024. So that's where I'm at. I don't love the call, but that's ultimately where the evidence is lying for me. Now, it could get worse next week, and things could certainly change. But I'm seeing sentiment, I'm seeing support, and I'm seeing a Fed that has breathing room here to get a bit more dovish. All right, I think that about does it. Appreciate you all tuning in to this channel and our podcast, Invest Talk. And a reminder that the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a great weekend.